like to introduce our honored guest, a speaker for this session, Mr. Amos Tan from Nomura Asset Management, Malaysia. Amos is a portfolio manager at Nomura Islamic Asset Management and is attached to the developed markets equities team based in Kuala Lumpur and works closely with the greater global equity team based in London and Japan equity team based in Tokyo. With that, I would like to hand you over now to Mr. Amos Tan. Thank you.
Hey guys, can you hear me and see me?
Yep.
Yep, awesome, thanks. Nashla, you got the slides? Awesome. Just give a minute just to full screen this. All right, cool. Thanks everyone for taking the time to attend this webinar. I'll quickly introduce my firm, myself, and how we can help you or your retirement. Very briefly, on slide 2, I work as a portfolio manager at Nomura Asset Management, the one before Nashla. Yes, that's right. You know, Nomura may not be a household name in Malaysia, but we are the largest investment bank in Japan. We are headquartered in Tokyo, and we are probably one of the largest asset management firms in Japan, managing about 569 billion US dollars. Nomura at NAM, or what we call it NAM was founded in 1959. So we've got a 27% market share in Japan with offices around the globe. I work in the Malaysia office, so I'm Malaysian like all of you guys are. You know, we are the largest foreign fund manager in Malaysia, managing about 30 billion ringgit, mostly for institutional clients, for pension fund, which is a very big client of ours. And we've won numerous awards for them. On the next page, please. And on the next. So that's a very brief intro of ourselves. We are making a foray into retail funds. So we'll be spending more time with the people on the ground, and I'll be in charge of this fund. On the next slide. So that's my boss. We all work together. Next slide, please. And I'll just briefly talk about Japan and Malaysia, and I wouldn't spend too much time about, you know, the comparisons between Japan and Malaysia. On the next slide, that it is no surprise that Malaysians are aging pretty rapidly, and Japan is probably the oldest society in the world. Their life expectancy is in the 80 plus years old. Malaysians live pretty long as well. Our life expectancy is 76 years old. And what I wanted to draw your attention to is that unlike Japan and Malaysia, Japan's inflation rate has been quite muted so far. But yet in 2012, they decided to raise consumption taxes, the consumption tax rate from 5 to 8%, and then they raised it again in 10%. The Malaysian government debt to GDP ratio is 61%. I repeat, 61% for Malaysia. In Japan is 210%. So there are some similarities, some differences. And, you know, one thing that I wanted to stress here is that they have a very low inflation rate, and inflation is my worst enemy, is your worst enemy, because it erodes the power of your dollar, in that the cost of your lunch increases, but the dollar value of your dollar remains the same. Okay, so over time, you know, when my mom used to say her bowl of noodles used to cost 50 cents. Today, I eat a bowl of noodles for $10, right? So it's completely night and day. Next slide, please. So, you know, as we grow older and we next slide. Yeah, as we grow older, I think the value of savings is something that you guys would appreciate, but you may or may not have seen that the average Malaysian shockingly has not very much in their EPF account, and EPF savings are not very much. And the audience here is amazing seniors, so above 50 years old. But I think many of you have children, and the product that we're launching is for seniors, but also juniors, and for people that are starting off to invest. Okay, and I wanted to give a bit of an investor education about some financial planning and savings, as well as talk to you about a product that we are about to launch. Next slide. So as the table showed earlier, the average individual has a savings of 185,000, which is probably insufficient. Average savings in EPF, which is probably insufficient to maintain a long expenditure, and half the population has 10,000, which to me is really that is really insufficient considering the cost of living. So take me for example, when I'm 36 years old, I used to study at an international school, and my dad, I asked him how much did my fees cost. 20 years ago, it was about 15,000-20,000. I went to have a look yesterday, a week ago, and it was closer to 70 to 80. So just think about how much costs have increased, not only for a bowl of noodles, but the big items are the education costs, which is huge. And this is why I'm really worried about the value about inflation and what we can offer to you. Next slide. So, many of us, including myself, we fall back on the EPF, and the EPF has done a very good job so far, very commendable. But as the proportion of older adults grow and the younger adults diminish, the payout rate also declines because the returns that they generate are also diminishing, and they have to pay out more to the older cohort. So what I'm saying is that you can see that the returns that EPF has been paying out have been diminishing, declining, and it would not be surprising to me that returns continue to remain on a lower trajectory gently. They're trying their best, but it's going to be an uphill battle. So the point is that we or many of us have to start thinking for yourselves. If you have savings or if you have retirement plans, I think I would urge you to invest wisely, but also to consider us as your investment partner. So many of us, I speak to younger folks, and they have COVID-19 savings. A lot of us have. I have quite a bit of COVID-19 savings that we work from home, didn't travel, didn't do a lot of things, and we are about to exit COVID-19 with the vaccines, and a lot of younger folks are going to just blow that savings away with buying the new iPhone Pro Max or travel or whatever. So I would urge you to really start investing if you haven't, or think about alternative plans. And what we're doing here in Nomura is we are trying to get you to invest overseas and diversify. If you have a large chunk of wealth that is charged and saved in Malaysia, I think we want to sort of open your eyes to the options that you have overseas. Next slide. And what should you do? So you should not spend, you should save and invest. Next slide. So I'll talk you through what we are trying to do and the product that we're launching. We have a product that has two funds. The accumulation phase is for people that are younger and you want to grow and accumulate your money, hence the objective of capital growth. And for the older cohort, you have a wealth and accumulation, and that is more capital preservation, and you want to draw down on your investments. You also want to grow your investments. So it's not just capital preservation, but also capital growth. And they are put in the same fund. We will manage it together, but the decumulation portion pays out dividends subject to availability of income. So next slide. So of all the slides, this is probably the very top I guess one of the most important slides that we have. And it may look like a very small table, but please zoom in. And I wanted to explain to you the power of compounding interest. And one of the key propositions of this fund is that it is lower cost. I repeat, lower cost. And the power of lower cost is very important when you invest in a unit trust. And I will take an example between three people. You have Mr. A, Mr. C, Mr. B, and Mr. C, okay? And Mr. A is 24 years old. All of them are 24 years old, and their parents give them 100,000 to invest. Mr. A is quite patient. He puts in 100,000 in one go, is not itchy, and I'll explain to you what I mean by not itchy, and earns a 6% interest. And by the way, 6% is the target return of the fund, okay? In the past, it has been more than that, but we are targeting 6%. Mr. B is Mr. A's good friend. Mr. B also invests 100,000 in one go, is not itchy, and earns a 5% interest. So the only difference between Mr. A and Mr. B is that they earn 1% difference between their returns, okay? And the reason why I put this 1% is because many funds have high expenses, a high expense ratio, and that eats into your returns. Mr. C is also a good friend, puts in 100,000 and earns 5% over time. But the difference between them is that he is itchy. And what I mean by itchy is that he wants pocket money and he takes out 2,500 every year and spends it. So you call Mr. A in 1 year with 6%, you earn 6,000. 6%, 100,000, 6,000. Mr. C takes out 2,500 a year. Okay. And you look, this is more for your children, but maybe also for yourself. You look over time, the power of compounding interest. When Mr. A reaches 60 years old, he has 814,000, just on a 6% return, doing nothing, buy and hold, not being itchy. Mr. B, who is not itchy, but has a high expense fund, gets 579,000. Think about the difference between A and B. All that made is just 1%, okay? A lot of people pay high fees and pay high sales charge, and that is the differentiating factor that we have, is that we are charging a 1% sales charge and a 1% management fee. And so that is the thing that we want to help you with, and that 1% translates into a huge difference over time. And what we want to educate you is not to be itchy and to take out money. And, you know, Mr. C takes out money, and at the end of the day, he only has $339,000. So the difference between Mr. A, Mr. B, and Mr. C is huge. And at Nomura, we want you to become Mr. A. In fact, we want you to be better than Mr. A. We want you to be A+, but let's just call A as a base case. And we also want to educate you on the merits of being patient, on buying and holding, and not timing the market. Next slide. So I hope that is an important investment concept that you can come and can take away after listening to this webinar. The second thing is some of you may be may have been in the stock market for a long time. Some of you may not, and some of you may feel very itchy. And what I mean by itchy is that you invest, prices go up, you take profit too quickly, or sometimes we make a lot of money or lose some money and you get emotional and sell. And so I wanted to show you the difference and the difficulty of trying to time the market. And say from 2010 and 2020, you made 119%. And if you had invested and you missed the 10 best days in the market per decade, you would have lost out a lot and you would have only made 95%. This is in the right box that you have, okay? And since 1930, if you guys have, just for illustration, you would have made 17,715%. If you had missed the 10 best days, and these 10 best days could have came in the middle of COVID. Everyone was so fearful. People thought that this was going to be the end of the world. And so the stock market will continuously surprise you on the upside and also sometimes on the downside. So that's why I say time in the market over timing the market. Next slide. So I think a very, very commonly asked question is, hey, Mr. Fund Manager, the market has went up so much, what is left? And I took this slide in November 2020 when everyone was asking me, what is left? We are back to the all-time highs. And back then there was no vaccine, there was no Pfizer therapeutics pill, and it was crazy. And no one believed it. And the market will continuously surprise you, and there will always be something to worry about. Last year, it is COVID. The year before, it was US-China trade war. There will always be something to worry about. And I guarantee you, there will always be something again in 2022, 2023. All right. And you look over time, the stock market has been a good place to put your money in. And do not worry about timing the market, which I mentioned earlier. So, by the way, in November 2020, the stock market, this is the S&P 500. It was 3,500. Today, it is 4,600. So look how far we have become, have turned a year from then. Next slide. So I'll spend a bit of just time talking about this fund and what we can do for you. Next slide. Think of this as a bento box. The fund as your bento box, and you have protein. You take a bento box, you have protein, carbs, fat. And what we're doing is try to create a balanced diet for you. And what I mean by that is we are going to be investing in a fund of ETFs, a pool of ETFs. And a pool of ETFs will have fixed income, will have commodities, will have equities, will have some allocation to US, some allocation to China. And this fund will be run out of from our team in Tokyo, and I will be managing the operational aspects of this fund. Next slide. There are times when you want more equities. There are times that you want to be more defensive. Take, for example, in April, May, June 2020, last year, when we were coming out of MCO1 and things were getting better, there was no vaccine, you wanted to be aggressive and you wanted a higher allocation to equity, and you wanted a lower exposure to fixed income. So the team in Tokyo will manage your asset allocation for you. All you need to do is just sit back and don't be itchy. Don't try and take profits too prematurely, etc. And we will invest this according to our risk assessments and our factor models. Next slide. We have been doing this for a while, so this is not our first ever product. The fund invests in ETFs. So ETFs is like your KLCI index. For example, you have the US equivalent, which is S&P 500. You have a tech index, which is called NASDAQ. And the accumulation fund is a fund targeting early savers. The accumulation is for the older cohort. They're targeting distributions. The advantage of this fund is it is a fund that invests globally and allocates globally, not Malaysia. You diversify globally. It is low cost, 1% fee, sales charge, 1% annual management fee. And remember the example that I showed you earlier between Mr. A and Mr. B, and what a difference Mr. A has at the end of his investing journey. That immense, those returns are a lot. Target return is 6%, subject to availability of income. Of course, with investments, there's no such thing as a guaranteed return, and I'll show you the track record based on our back-tested results. And the suitability aspect is this fund is appropriate for clients that are looking for a long-term, stable long-term returns over time. This fund is not a fund that will shoot the lights out in 6 months. This is the slow and steady fund. Okay. Next slide. And I'm almost done. Next slide. Yeah. So next slide. So the differentiating factor is next slide. Yeah. If you can just zoom in, I think the differentiating factor between ourselves and many funds in the market is that this is a low cost fund that can invest in ETFs. And many funds in the market right now invest in stocks. And stocks are a very good option, but in many cases, you do not have ability to invest in something that is up and coming. So for example, Bitcoin ETF, you can invest in commodity ETFs. We don't intend to invest in Bitcoin, but that's an example of what the power of ETFs. So this is a back-tested return. This is my last slide. If you zoom in and you look at the returns are above 6%. There are years that we make more than 6%. There are years that we make slightly less. And you notice in bad years, we don't lose so much. So there will be years that will be very challenging. For example, the Great Financial Crisis, GFC in 2008. You put your money into an equity portfolio, you would have lost 50%. You put your money into this fund, you'd have lost 10%. In 2020, things were very bad, but this fund managed to hold in just fine. Didn't make too much, but didn't lose too much either. So all that being said, we hope that we can help you. We have on the next slide, this fund is going to be launched hopefully by the end of the year. Next slide. Yeah. And we are launching several other funds. We have equity funds and we have fixed income funds as well. For the equity funds, we have a global high conviction, an ESG fund called the Global Sustainability Equity, and a mixed asset fund called the Global Sharia Fund. So we are launching 1 or 2 more funds and I hope that we can be your partner in investing. So why don't I leave it there and stop for any questions that you may have.
Okay, thank you, Amos. We do have some questions from our audience here. There's one coming from Chin. He asked, the government allows withdrawal of our retirement fund, EPF. Do you think withdrawing some of our EPF funds to further invest for retirement life is recommended? What do you think, Amos?
I think it depends on what fund you invest in. I cannot give you a straight out answer for, the advantage of EPF, and I speak for myself, is that EPF offers you a safe 6% per annum. Rain or shine, you'll give you say 5.5%. So if you're looking for something that is higher risk and maybe higher return, then you should take out a part of it, but you should also invest overseas. And I think that is the value add that I can give to you today. And pick one that is low cost as well.
Yeah, thank you, Amos. This question is from me, personally, from me.
Sure.
Is investing in China-based funds a viable option? Actually, I have invested about more than half of my retirement funds in China-based funds. I think there's one called the Phoenix Fund. I can't recall. Is this a viable option that you would recommend to our retirees to look into overseas funds? For example, China, Japan, Far East, those countries. What is your opinion?
I'll just give you my personal take, and my personal opinion is you want to be you have to pick you cannot pick China fund as a broad brush and say, I want a China fund and, I'll buy a China fund, but you also have to look into the track record of the fund. The second thing that I would say is, for all of you that have invested in China fund, and I pay close attention to China, what you have learned in 2021 is that many of them run first and foremost for the government. And the difference between the US and China is a matter of philosophy, right? One is a communist country, one is a democracy. And at the heart of American firms, they run for the shareholder. The Chinese companies, many of them run to serve the Communist Party, but they do care about the shareholder as well. Okay, but the first and foremost, the priority is the Communist Party. So I really feel that many of these Chinese companies, especially the state-owned companies, have a different agenda in mind, and you want to be careful about this because you want a company whose management team is working for the shareholder and is focused on growing their wealth and your wealth as a minority shareholder. So I think that's the difference between a Chinese company, a Chinese investing in China, or the first thing is not only investing in China, it's investing in Malaysia, right? And investing in American, Western companies. The second thing that I would say is that many people ask me about China funds because China GDP is 6 to 7% per annum, and US GDP is 2 to 3%, Japan is 1%, and they make the mistake of comparing GDP growth to a stock market. GDP growth is very different from stock market. You take, for example, Google, okay, or US, or investing in a Japan index. Over the past 10 years, the second best performing region of all is actually Japan, with a 1% GDP growth. In some years, they even had recessions, right, because of the consumption tax. So please do not confuse high GDP growth from stock market returns. In Malaysia, you have pretty decent GDP growth, but if you look at the KLCI over the past 5 years, I don't think it has done very much, and you had to take quite big bets into small cap companies to achieve pretty good returns. So please don't confuse GDP growth and stock market returns. And obviously the best performing region of them all is the US. So I hope that you answers your question.
Yes, you gave me some broader insights today, actually.
Yeah.
Okay, there's another question leading up from investing overseas from Sue. She asked if I invest my funds overseas, come 2022, will our dividends be taxed?
I don't have an answer to that. We are in the process of finding that out for ourselves. So it is an answer that I don't have at the moment. I'm sorry. I hope not, but yeah, we are looking into that as well.
Yeah, I hope not also.
Yeah.
Okay, I have a question from Shukri Hamid. What is the risk when the Fed, I think he means the US Fed, does the tapering? I don't know what he means by this.
Yeah.
The S&P is at an all-time high in everything rally, and this was called by Tom Lee of Fund Stress. He is expected the S&P to peak at 5K. Are our returns at risk? And do you have shorting to hedge the risk that we might see at top after the COVID bottom in May last year?
So, Najla, could you go back to the slide of the long-term slide on page 18? The market has went up so much, what's left? This fund, and I hope that you invest for the long term. And we had a tapering event in 2013. Okay, in 2013, and this is not the first time that we're going through a QE, through a quantitative easing. And what he meant by that question is, the U.S. government is printing $120 billion. At the moment, they are going to be winding down that stimulus. That stimulus is responsible for the stock market rallying the way it is. It's not the only driver, but it's one of the very big drivers. And the concern is that as you pull the 120 billion, the stock market will falter. And the market participants, everybody knows that we are going to have less stimulus in the system. We knew that in 2013, and if you were worried about all this noise, okay, in 2013, you would have said, I'm really worried because we had QE1 in 2013 and QE2 back in 2013. And I said, as they pull the stimulus, I'm going to sell and I'm going to take my profit and thank you very much. And I'm just going to spend it all and enjoy it. And look what you have had missed from 2013 to 2021. Okay, you have missed a lot. Secondly, what happened in 2013 is playing out again in 2021. And you can have all sorts of market experts saying that the market is peaking, they're bearish, etc. Okay, just look at you can watch CNBC all day, and I remember in the depths of the market where people were overwhelmingly bearish and saying that we are going to hit 2,000 on the S&P, and then there were people that said that things were very bad and we were just going to go down. And at every time, they were wrong. And I'm not saying Tom Lee is wrong or right. I'm just saying over time, the market goes up. Secondly, this is a multi-asset fund. This is not just a pure equity fund. And that's why you don't have all your eggs in equities. You have some in commodities. You have some in fixed income as well. In fact, you have quite a bit in fixed income. So that would provide a buffer for the fund volatility and downside. And I hope that answers your question.
Okay, thank you. Very good question from Shukri.
So Shukri, maybe I'll just continue Shukri. Shukri says William Larry and Tom Lee have called the bottom of the market. Maybe they had, maybe they are renowned experts that come on CNBC, and I watch Tom Lee from time to time. But I think the purpose of this fund is The purpose of this webinar and the fund is not to time the market. I'm telling you, focus on low cost funds, focus on stable returns, not in and out. Because, by the way, if you sell, and then you jump back in, you're going to pay a sales charge. That is for sure. And the sales charge for us is 1%. For some other competitor, it could be 5%. You do that all the time. At the end of the day, the person that is going to be rich is your unit trust agent, not you. And I'm sorry for being blunt, but that's just my 2 cents worth. Next question, please.
Okay. Moving on, we have a question from Amanda, which is a very general question, and I think a lot of this question is on our seniors' mind. What type of funds would you recommend, Amos, for seniors who are looking for decent dividend payouts for seniors to enjoy the benefits of the investment in a sustainable manner? So what type of funds would you recommend for seniors, especially in our platform here?
So we're going to be launching this fund, hopefully by the end of the year. And this fund will take a bit of time to get some traction to paying out returns. And I hope that you can consider us. And in the meantime, maybe you can speak to your, you can reach out to us in whatever way, and we'll put you in touch with the funds that we can offer. And we can take it from there. We have several funds that that pay out dividends, and I manage one of them. So we can take this offline. You just reach out to Amazing Seniors, and they can put you in touch with us. And this applies for all of you.
Okay, thank you. Great. So reach out to us in the Amazing Seniors if you have more inquiries with regards to the funds from Nomura. And especially there's one question from Rachel about the new fund that you'll be launching soon. So they are quite keen to know more. There is another question from let me see. Chu Pozi asks, she doesn't have much confidence in unit trust funds offered in Malaysia. Okay, I think this goes for a lot of people also. She said that I have some public mutual funds, right? After more than 10 years, it grew by losses more than 1%. So she asked for your comments on why is it happening in such a way? Why is she making a loss even after 10 years?
I'm sorry, I cannot comment on someone else's fund. I can only speak for my fund and the funds that we manage. If you are ever interested in switching to my fund, you can reach out to us. I manage one fund investing in global equity. I put my own money into that fund. So, your pain is also my pain if we lose money together, and we can get in touch separately offline if you want to know more about the funds that I manage and the funds that we have. So you will be able to see the funds that we have, and also I manage one fund that is not on that slide as well. So we can help you. I can't talk about other funds, unfortunately.
Yeah. I understand. So basically, what we do is we will direct all inquiries on our platform to you. Yeah. And there's one from Maureen. She asked that if you could leave your contact details for the platform for them to contact you.
Yeah, Nashla, I have my colleague over here who works in business development. She can put her contact down, and then we'll try and we want to help you. I want to help you.
All right, great. And one last question before we end your session, Amos. Would stock picking active fund do better than passive mandate fund in emerging markets and developed markets?
I think
Stock.
so. If I can leave you with a couple of statistics, is that you want to you want to allocate quite a bit of money in passive investments, and in passive investments you have the ETFs. And why passive? Why do ETFs? Sorry, there's someone that is not on mute. Could you please mute your line, or could you, if the host can mute everyone's line? I think that person is KH Lee. So if you can just mute your lines, that would help everyone.
KH Lee, can you please mute your microphone, please? KH Lee.
Yeah. Okay. So it's hard to say, you know, passive or active fund manager. What I wanted to say is focus on managers that charge low fees, and for certain, the certainty is that low fees will help your returns and will not eat into the returns when you have years that are not so good. So think about the example that I had in Mr. A and Mr. B, and it's just a 6% return, and the difference is staggering over time. So this fund has a low fee structure. I mean, we put it, you know, as low as we could possibly do. We need to make some money ourselves to cover the expenses, and I hope that really helps the investors that come in. And this fund is more passive, so it's not about taking big bets on specific companies. Active management has its merits, and there are several very successful active managers as well. I think we also want to tell people that this is not a fund that is going to be that offers super turbocharged returns. This is your slow and steady fund that is for retirement. And if people are worried about the downside, an index, if you have a index that goes down 20%, there's a very, very high chance that your underlying stocks in there, whatever you choose, will also go down. So I think there's very good benefits of index investing, and in this case, the ETFs. And by the way, please feel free to ask any questions. Look, I want to help you guys, so I've got time if you have any more.
Okay, actually, we have run out of time. Actually, I've asked the last question just now. So thank you very much. Thank you very much, Amos, for your time and a very insightful presentation on your fund. We'd like to take this opportunity to thank you again for sharing your insights with us, Amos. Thank you so much. Okay,
thanks.
Coming up next, guys. Coming up next, we have Sunway Medical. Sunway Medical will be talking to us about the Big C, and I think you guys know what the Big C is and some of the myth that surrounds the Big C. And please stay tuned for this session, because Sunway Medical will be giving out free health screening sessions. So you don't want to miss out on this. These free health sessions that we will be giving out by Sunway Medical. So stay tuned. We'll be back in 5 minutes. Thank you guys for staying with us.